Fed makes its rate decision as US inflation drops and retail sales disappoint. Could this be the last US rate rise this year? Indices trade little changed on Wall Street ahead of the FOMC announcement in 15 minutes' time. Elsewhere, the dollar takes a tumble as today's economic data opens the debate about whether the US economy has peaked. But could we have a hawkish surprise? Markets are seeking fresh clues on future monetary policy. Welcome, this is IGTV here to help you trade the FOMC announcement and the markets following the release. With a 25 basis point rate hike already priced in, market reaction in the aftermath of the meeting will depend almost solely on the Fed's future monetary policy guidance. Today's decision comes with the added ingredient of a bigger than expected drop in inflation and also a poor retail sales number out earlier today, both for the month of May. The May employment report was also softer than expected a week or two ago, which showed not only a slowdown in hiring, but also downward revisions for the prior 2 months. Now, joining us now for the show is James Butterfill, Head of Research and Investment Strategy at ETF Securities. James, welcome. What's your base case today?
Rather boringly, a 25 basis point rate hike. It's unlikely that they won't hike. Yes, macro data has been disappointing recently, particularly retail sales, but it's not enough to not warrant a rate hike. Actually, there's a 94% probability, according to futures market, of a hike. It will shock the market if they don't.
Yeah, okay, all right. James, thanks indeed. Back with James in just a minute. Also with us is Chief Market Analyst here in London at IG, Chris Beauchamp. Chris, what's the base case from IG clients' point of view?
Very much the same here. What's expecting the Fed to hike? The question is, I suppose, if the Fed, if you like, ducks this one, what happens if they don't raise rates? I think the bigger worry there is that you see further losses over the longer term for the US dollar. Admittedly, we've seen a big fall in the dollar over the last few weeks, a combination of political and economic uncertainty, but I think you could see more downside if they really do give up on this one.
Okay, all right, thanks indeed. Also joining us from New York is David Song, forex strategist at DailyFX. David, what are you seeing?
Hi Jeremy, thanks for having me. And we're seeing the US dollar struggle to hold its ground following the weaker than expected data prints from early this morning, and it looks as though we may see the US dollar stay under pressure, especially if we do see Fed officials adopt a more cautious outlook for the US economy and highlight a more shallow path for the Fed funds rate.
And we're back with David a little bit later on in the programme. And live on the IG trading floor for us on this Wednesday evening is William Croft, Premium Client Manager. Willis, where's the money flowing at the moment?
Good evening, Jeremy. Yeah, well, we've got clients positioning themselves on two main markets, obviously FX and indices. FX, 2/3 of clients short euro dollar going into this. We have had some support in the last 30 minutes of buying of that currency pair. Over half clients short GBPUSD. And even more selling coming into this rate decision. And US dollar basket, that is the interesting one here. 80% of clients long, some strong support from the dollar from IG clients, and we've had some more buying in the last few hours. Indices, clients still overwhelmingly short major indices, including the Dow, and nothing's really changed in the run up to this. Still clients selling the Dow. So yeah, we'll have to see where we end up.
Yep. Okay, all right, Willis, thanks indeed. Also back with Willis in just a few moments' time after that decision to see where the client flows are going. Now, this show is for you, the trader, and we have brought these guests together to help you trade the markets and decisions like the FOMC and to answer your questions. To send your questions, it's really simple. Just download the Slido app and enter the event code, #June-FOMC, and then send in your questions, and we'll put them to our guests here. Now, while you're doing that, let's take a look at the markets in some more detail. We've been hearing a lot about what's been happening with the dollar. This is the dollar index, and we've got this big pullback in today's session. This is a daily chart. And in fact, if you can see the hourly chart, it's a bigger than expected fall in inflation. This saw the hourly chart with the quite clear markdown for the dollar. And in fact, if we go back to the daily chart, you can see, in fact, the dollar at the moment, dollar index trading not too far away from where it was when President Trump was given the vote and the keys to the White House back on the 9th of November. That's a very volatile day that we saw there. And since then, the dollar was up and away. But you can see now that we're not too far away from that level of 96, which is where it all started out, 95, 94.9. In terms of where we are on the markets, William Croft was talking there about the overwhelming sentiment sentiment short, but in fact, this is the Wall Street. This is Wall Street cash, which is the Dow Jones Industrial Average. This has been at record highs, intraday record highs today. Also, taking a look at what's happening as well with other parts of the market. When taking a look at the dollar basket, it's also worth looking at other currencies. This is sterling against the US dollar. Big rise, or relatively speaking, for sterling away from the recent lows on that weaker US dollar. And also for the euro dollar. I've not got euro dollar in front of me at the moment, but it's the same message that we've got a drop at the moment for the dollar against a whole basket of currencies. So money going in to some of these equity indices. Just a quick go back once again. In fact, take a look at the intraday. We've seen a little bit of a drop for the US 500. And we are down a touch on the session there, awaiting that breaking news headline at the top of the hour. We've already got some questions coming in from the guest. If the Fed chooses not to raise interest rates, how many pips slide would we see? James Butterfill from ETF Securities is with us. I mean, this is an outside chance, I think. The markets seem to be so convinced that we've got this interest rate rise in the bag. If they don't deliver, where's the big reaction likely to be?
Yeah, I mean, the dollar's already been selling off on this weak CPI news. I mean, it's important to remember that actually CPI data, a lot of the weakness has been due to the falling gasoline prices. So actually that's an economic stimulant. So I'm sceptical that it will happen, but if there is no rate hike, then we will likely see much further weakness in the dollar and further strength conversely in gold.
Yeah, okay. Chris, next question for you actually come through on the foreign exchange market, something I know you've been watching, and this is about the sterling against the US dollar. If there's no change by the Fed, and again, as I've just stressed, this is an outside chance, what happens to sterling dollar?
Well, I think it continues to rise. We've seen two very strong days for the pound against the US dollar, despite what you might think would be a testing time for the pound. Of course, we've got the Bank of England tomorrow, so it's still, if you like, all to play for in that sense. But they are unlikely to move on rates. I think it's bigger news, certainly, if the Fed ducks this one, as we were saying. And you could easily see it pushing back above 128 is not entirely implausible, I think, at this point. The bigger question is, can it get through 130? Because that's been such a huge barrier over the past month or so.
Yeah. Chris, again, what about oil prices? How does this all affect oil prices? We've seen oil down today.
A weaker dollar would tend to lift commodity prices, standard thinking on that one. And again, you're seeing oil prices that have been battered heavily over the past month or so since that OPEC meeting, trading at 52 and then trading now down towards 45, almost to 44. 44 is the low, of course, from May. It would suggest that you might get a rebound if that dollar continues to fall. But that, of course, clashes with this ongoing narrative of what happens now to oil prices, given that production continues to rise. Reports in the newspapers today that you are having this classic situation where they're keeping oil in tankers offshore because they simply do not know what to do with it. Demand from China dropping off a cliff, even US demand not as strong. So the question there is, could we see further declines in oil over the longer term? I think in the short term, if the Fed don't move this evening, I think you get probably a bit of a short-term bounce in oil.
Yeah, this goes back to your point, I think, about the dollar, doesn't it? In fact, if we are seeing a low for the bottom of the dollar in this cycle.
If this happens in the way we expect it to, in a 25 basis point hike, then we've probably seen the lows in the dollar. It doesn't suggest there's a huge amount of upside from here, but certainly if you look at CFTC futures positioning, which is a good gauge of sentiment, there's been a big downscale of this positive view at the start of the year. I mean, I'd also add on oil. In the United States, the marginal cost of production is around $40 a barrel now, so actually very competitive relative to OPEC these days. So that's probably the lower floor for the oil price in our view. As soon as you hit that marginal cost around $40 a barrel, it really starts hurting production in the United States, which is very supply elastic. So we're likely to see it stabilise around that price, and our view is it still range trades from $40 to $55 a barrel.
Yeah. What about gold in with this as well? Because does this have, is there a follow through from this if the Fed makes an outlying decision?
Yeah, I mean, the very interesting thing about gold is in the run-up to rate hikes, gold tends to sell off. And we as a firm at ETF Securities tend to see outflows in gold. What's interesting this year is we've seen one rate hike and quite likely another, and yet we've seen $550 million of inflows into gold. So clearly investors are holding gold, and we think it's for several reasons. One is uncertainty from what happens when you raise interest rates. What sort of market instability does it create? And the other is there's an awful lot of fiscal and political uncertainty out there. And for those reasons, I mean, we've got the Greek debt decision tomorrow, we've got the German and Italian elections, we've got the ongoing saga that is Donald Trump. All these sorts of issues are likely to maintain the appetite for gold, and a no rate hike in particular would be quite positive. We could easily see gold test 1300 in that respect.
Yeah, we're getting a lot of questions in actually from Slido, and in fact another one for you, James, which is all about the tech stock, the big wide swings we've seen in techs over the last few days. And we saw a lot of these big tech stocks fall back into last week and into this week, and there were a lot of questions I know on a lot of finance channels about, is this the beginning of the big turnaround of tech stocks? But there's been a subsequent turnaround again. Is anything likely to come out of the event tonight for tech stocks? Let's
compare the tech boom in the dot-com bubble and today. Valuations are very different. On the Nasdaq, they were 80 times price earnings. Today, they're 25 times price earnings. Actually, on a relative basis, tech looks quite attractively valued. We'd also say that balance sheets are quite a good place. They're cash rich. They have low leverage. So actually, the fundamentals, if you look at actually average earnings growth, it's around 8.5% versus the broader market at 4.7%. So actually all the fundamentals for tech look quite good. So as long as it goes in the way we expect it to, I mean, even a rate cut would, or sorry, a no rate rise would actually be quite positive for equities. So I think it's in danger if the Fed express a very hawkish tone, which we think is unlikely.
Yeah, Chris, let's bring you on this. This is the US Tech 100 on the IG platform, which equates to the Nasdaq Composite. I mean, we've spoken about this before. I mean, this idea about buying the dips would seem to be for this index as well.
Yes, I think, and it's something that's come across again thanks to that sudden dip on Friday. Is this the beginning of something? And you can always see plenty of people coming out of the woodwork every time this market does sell off. I think the rapidity of Friday's drop shows that maybe there's not as much liquidity in this market as there should be. Maybe that everyone is finally on one side of this trade, but you can only go, I think, with this trend, as James was saying, you are seeing compelling valuations compared to what we had in the last boom. I mean, everyone's tendency is to compare it to last time around, but we do, not this time is different, but we are slightly in a more attractive world for tech stocks, and I would not be surprised at all to see us back at the all-time high within a couple of weeks on this one, simply because this is the way the market has trended all year. We've had a very quiet market in February, March, and suddenly it's exploded back into life. And you should be prepared for this kind of thing. But that doesn't disrupt the overall trend there, which you can clearly see is a one-way market. Not just over the last few months, but going back to 2009, it's one of the strongest trends you can possibly find. So there's little worth, I think, so far in arguing with it.
So, which leads us nicely into the next question, which I think you've already answered actually, is if we get the status quo as expected, I mean, do indices keep on hitting new highs? And I guess the answer to that is almost certainly yes, Chris.
I think it depends on what you see in the statement, certainly from the Fed. If they express any more caution, because if you look back to last time, they were talking about how Q1's weakness in the US economy was transitory. And if this is suddenly less transitory than the Fed thought it was, or more permanent, whichever one of those you want to take, then you might get some more jitters coming through. I think that stocks are probably more vulnerable, certainly in the summer period, to a greater degree of volatility, or out of that very strong seasonality period for markets, so sort of October to December and then January into April, May, when it's a very strong time for markets. The summer's not abysmal for stock markets, but it's just never quite as ebullient. So maybe the risk is elevated now that you get something of a modest sell-off, but until we see something of a dramatic correction, I would not want to argue with this trend either in the Nasdaq or indeed in the Dow Jones or the S&P 500.
Yeah, it's interesting actually. Another thing, James, you're talking about is the fact there's a big difference between, and the Nasdaq at least, between 2001 and now. There's been a lot of reports recently about this credit impulse, that people understand that, say that credit is saturated in the US and China. I mean, this is very different now from when it was just before Lehman Brothers. Interest rates were higher then, we had all the debt problems. There's been some sort of address of that of some of the banks. How different do you see the markets now from pre-crisis levels in 2009?
In the households in the United States and in the UK, the debt service ratio, that's how much are the households spending on interest, and it was around 13% of disposable income in the United States back in 2009. It's around 10%, 9% now, so much lower in that respect. And if you look at corporates, if we look at the equivalent, the EBIT to interest coverage expense, what you find actually is in the large caps they're quite well positioned. They have about 7 times EBIT, but it's the small caps that's a problem in the United States. It's only around 2 times, so they're much more vulnerable to a more hawkish policy from the Fed.
Yeah. Okay. All right. Stay there just for a couple of minutes. We're getting these breaking news headlines in just a few moments' time. As we look to what's happening in these markets, I want to start off, if I can. Let's take a 5-minute chart for the euro dollar to give us a little bit of what's going on with these markets as we get the headlines in. You can see money going into the euro at the expense of the US dollar, and we are looking for these interest rate headlines. 25 basis points as expected for interest rates in the States. We've been monitoring a little bit of money going into the euro dollar. In terms of Wall Street cash as well, we've been talking a lot about this index and so what's happening there, and really it was not an awful lot of move in the indices. If anything, a little bit of money coming off the table. So this Fed decision absolutely in line with expectations, and I think we got there's the headline you can see there, 25 basis points. Be interesting to see what the dot plot looks like. We'll get James on this in just a few moments' time. He's looking through some of the headlines that we've got. That's the way in which the Fed has its attitude on future interest rate decisions. We've been looking previously for a 46% chance for December quarter point rate rise, 18% chance for September rate rise, but also in this is the Fed's attitude to the way in which it might or might not start to change the emphasis on its balance sheet. It has bought a lot of these bonds. It's this QE program has brought a lot of bonds onto the balance sheet, and it's not just the Fed that's doing this. It's the European Central Bank, it's the Japanese Central Bank, it's the Bank of England as well. We get the Bank of England on its interest rate and QE decisions tomorrow, but at some point these central banks have got to start unwinding this, and that would have the effect of raising interest rates. So the fact that an interest rate rise is now looking a little bit less likely for September is not necessarily a surprise, because it could well be at that September meeting when we see the Fed make that decision on whether or not it wants to start looking at ways in which it can start to trim its balance sheet. This is a 2-minute chart for the Wall Street cash on the IG platform, which is the Dow Jones Industrial Average, and quite frankly it's not really moving an awful lot. And in fact, you go back to any of these charts, this is gold, you've seen a little bit of a spike up. That's the daily chart for gold. Just bring you back to a 2-minute chart for gold. Well, there's the immediate reaction, but I mean, bearing in mind this is a 2-minute chart, you're going to get these wide fluctuations anyway. But the bottom line is we're really not too far away from where we are just a matter of 15 minutes before this interest rate decision. So that's the position we're at. Volatility quite often is always the case. The Fed anticipates $6 billion of drawdown initially, increasing every 3 months. Now we're talking a little bit about the way in which the Fed is positioning itself for the attitude towards its balance sheet. I think the dot plot is looking like it could well be unchanged. In fact, this is the way in which the Fed is looking at the way in which we'll get the future interest rate decisions. And that really is no real surprise. The only thing is, I think, to consider is the fact we had that weak data today on inflation and also weaker than expected data as well of retail sales. And I said a couple of weeks ago, we saw that weak jobs data as well. So these are the headlines that we are getting through for you today. And as we continue to monitor what's happening in these markets, it really is a muted reaction in these markets. Here we have the NASDAQ index here, a little bit of volatility. Again, it really is just a question of where we are on the picture for the markets across the board. So not really changed very much. I think now we can go to David Song, I think currency analyst at DailyFX in New York. David, what do you take out from this, and what are you watching in terms of some of the charts?
So right now we're seeing an initial bullish U.S. dollar reaction, and for now it looks as though the Fed is trying to relay this message that compared to 2015, 2016, we will see this more aggressive approach in terms of normalizing monetary policy. So it looks as though they'll continue on with this maybe 3 hikes per year sort of pace over the coming year as well. But right now, we are getting some hints that we could see a little bit more of a detailed exit strategy going forward. And again, tend to start that program later or the exit later on this year. So initially it's bullish, but if you looked at the new forecast maybe it's going to be something similar to what we saw with the European Central Bank, where they cut their inflation forecast because of weak energy prices. We did see the Fed trim their inflation forecast for this year to an annualized 1.6, but next year they still expect inflation to trend towards that 2% goal. So I think for now markets are still chewing on what this means, that even though the Fed has reduce their inflation forecast, so they're really trying to encourage this idea that they will stick to their pace of maybe 2, maybe 3 rate hikes per year. They will look to taper the asset purchase program going forward. But I think all eyes will be on Yellen now, because I think there is some disconnect between some of the inflation forecasts that we're seeing versus the language that we're getting out of the Fed. So for now, it looks as though initially the dollar's benefiting off of, again, not only the hike, but this language that the Fed will continue on with the more aggressive approach in terms of raising that the Fed funds rate. But for now, again, I think we need to see what Yellen is going to strike and the tone that she's going to strike, because I think there's some confusion about what this data means for us.
So what's the position then that traders that IG traders should take on the dollar from this point on? We've been hearing from our guests here in the studio that we could well be seeing a bottoming process now for the dollar potentially. What is your thought in terms of the dollar trade? Where is the keen trade to go?
Well, for now, I would probably look at these major central banks who are largely endorsing this wait-and-see approach. So, for now, I think the Bank of Canada is taking it out of that picture after those hawkish comments from Ms. Wilkins. But for now, like Aussie dollar, I think that looks good. We got that pop higher, even though we did see some mixed data prints coming out of the Australian economy. But Aussie, even the Kiwi dollar, they look a little bit exhausted, especially following the recent advance. And as we still largely expect the RBA as well as the Reserve Bank of New Zealand to stick to their wait-and-see approach throughout the remainder of the year, and with both of those central banks in no rush to remove the record low interest rate, I think those are some of the counterparts that we can actually see the greenback gain some ground on.
Yeah, David, look, we've just got a question in on Slido. We're getting questions from clients, and one of them is about the Australian dollar. I think one of the interesting points about the Australian dollar is that it's past this 76 level. Let me just quickly get that up. That's not the Australian dollar while we're talking about this. It's just past the 76 against the US dollar, and it continues to trade a little bit higher. We've got Australian jobs data out tomorrow. What are you watching to give a steer higher for the Aussie, or do you think it's reached a peak?
So for now, just to put everything into context, the Aussie dollar exchange rate still is still operating within that 2016 range. So, you look at on a bigger picture, is there really a directional bias for this? I don't think so. Maybe we're waiting for a little bit more clarity on not only the RBA, but what's going to happen with Australia's AAA credit rating. We've seen the financial sector there largely come under pressure, and financial institutions getting their ratings cut, and as a result, we saw the RBA respond to that in terms of their repo collateral. So a lot of things hanging over the Australian economy as they're still adjusting to that credit boom. But for now, in terms of the Aussie dollar exchange rate, it seems as though the recent commentary from Philip Lowe may not be enough to hold up the Aussie dollar. So for now, a very nice range, and especially if you're watching the range from earlier this year, we're not too far off of a resistance zone. So if we continue to stay capped right around that 77.30, 77.70 zone, might be a nice region to watch for some key resistance going forward. But looking at the fundamentals right now, one dynamic that I am watching for the Australian employment report is whether or not some of those part-time gains can continue to transition to full-time positions. So, a key dynamic we've been watching for the Australian economy, even though the RBA warns that wage growth remains very subdued in the region. So, we want to see if those positive dynamics will continue. But again, I'm not sure if that will be enough to really encourage the RBA to move, at least within 2017. I think maybe once we get close to the end of the year and we see how the economy continues to operate, maybe we'll get a better sense of, how we could see the RBA shift their tone for monetary policy. But for now, that's where I like watching the Aussie dollar. I think we have some nice clean ranges to watch for Aussie dollar exchange rate. And even with the Kiwi dollar, the RBNZ, they continue to retain that verbal intervention on the currency. And for now, it seems as though Governor Wheeler will not move before he's set to leave the central bank in September. So, until then, it looks to the picture for the RBNZ will stay largely unchanged. So with that said, again, we'll see if the RBNZ will continue to cast a cautious outlook for the region.
Okay, all right, David, thanks indeed for joining us. David Song, DailyFX currency analyst there in New York for DailyFX. Don't forget you can join us on Slido app and put in an event code, #IG-FOMC. Questions continue to come in. Let's now go back to our trading floor. And Willis, with some more of what's been happening, what have clients been trading? Where's the money flowing?
Yeah, it's been pretty interesting actually. I mean, ultimately this has confirmed what people would actually position themselves for. One thing that I always find interesting in these scenarios is looking at the amount of orders that we get through per minute. In the lull before this came out, we were getting about 80, 90 per minute. That spikes up to over 3,000 when something like this is announced. Something I found quite interesting, looking at our exposure bars here, you can see IG's exposure to clients, the different orders coming in. We actually had quite a lot of people buying major indices, which was different to a lot of the positioning before this decision. So that's something quite interesting to watch. Euro dollar, a lot of selling in that. Strength really all over the dollar, lots of clients buying any dollar products. So yeah, apart from that, it's pretty standard. There's not been too much movement, and it's really just kind of been enforcing those positions that clients took into this announcement.
What are clients focusing on now then? Where do we go from here? We've got this now in the bag as expected. What are you discussing with clients from this point?
Yeah, well, really for the rest of this week, there's two other main things we're looking at: is BOE and BOJ announcements. Now that this is out of the way, had a few discussions with clients about FX positions coming into this. People looking at inflation in the UK compared to inflation in the US, whether that's more likely or less likely to lead to interest rates coming down more in the UK or going up the rate at which they rise in the US. So some trades possibly open there, and really just something that it's just been on the tip of everyone's lips over the last couple of weeks is looking at something like Bitcoin. Lots of clients interested in that. The interest in that over the last couple of weeks has been phenomenal. So that's often been what we're talking about.
Some would say it's got to stop at some point. But what are the main points to mention about Bitcoin?
Well, the thing is, there's still a lot of unknown about Bitcoin. You've got those people that obviously clearly believe in it. You've got those people who think it really, like this whole cryptocurrency stuff, resembles very similar to what we had with the .com boom and crash many years ago. So it's, I think the biggest thing is understanding its use, and those people who believe in it compared to those people who just think this has just gone. People have just massively piled in, and it's all overplayed. So we do have a lot of two-way trading in it, but it's just really the interest in it. It's just been phenomenal in the last couple of weeks compared to what it was, let's say, just a couple of months ago.
Okay, Bitcoin trade at 25.67. Willis, thanks indeed for joining us. Let's get back to our guests here, James and Chris, here in the studio. We're getting a lot of questions in. And in fact, first of all, before we get to the questions, what did you notice from the statement that came through from the Fed? We got this 25 basis point increase as expected, and they're now talking about the balance sheet, which is interesting. But what for you stood out as the points to mention? Slightly
mixed statement, actually. So if you look at the dot plots, well, the overall for end 2018, the median forecast for end 2018 is 2.125. And so there's no change there, but when you look within the dot plots, you see a couple of Fed members, 2 or 3 Fed members have upgraded their forecast for end 2018 and then 2019. So there's a little bit of hawkishness tone in there. This is upgrading the forecast for the US economy? No, for the Fed rate. Okay, then if you look at, they've moderated their CPI outlook, their inflation outlook, so slightly down. So that's a slight mixture there. And also, then if you look at the real GDP growth, they've upgraded it from 2.1 to 2.2 for 2017, and the unemployment rate, their expectations there have moved quite a lot, so from 4.5 down to 4.3 for 2017 and 4.5 to 4.2 for 2018. So there's some mixed signals in there, in my opinion. There's a few hawkish things, and then on top of that, we've got the discussion on policy normalisation. It now looks like probably this will happen in December. Policy normalisation is the words for what? Yeah, this is the scaling back of the balance sheet. The Fed's with QE has built such a massive balance sheet, they need to start scaling it back. In our view, this is what they do instead of a rate hike in December. So perhaps another rate hike in September, and then policy normalisation really starts to kick off in December. And that has the same effect, doesn't it, of increasing interest rates, because it's drawing in, it's restricting monetary supply. Absolutely, yeah. You're reducing the amount of money in circulation. So essentially, so is it dollar positive, dollar negative? This should be dollar positive, although I think moderately so. It's quite a mixed statement here. I mean, if you look at the DXY, which is a trade-weighted dollar, our expectations towards the year end is that it probably would hit sort of 98. It's currently at 96 at the moment, so a moderate upside from here potentially. Yeah. Okay. Chris, what stood out for you in the numbers in terms of some of the headlines? I mean, we've got, as I said, as expected, the main decision.
I think it's the policy normalisation that's really the interesting dynamic here. It's how you will play these two elements of monetary policy tightening over the next few years. Essentially, the Fed's addendum to their statement was noting that they'd start at about $4 billion a month and then increase that at 3-month intervals until you hit a rate of $20 billion a month in terms of unwinding QE. But the caveat, of course, in the statement is provided that the economy evolves broadly as anticipated, which is Fed speak for saying this is what we want to do, but obviously we're keeping our options well and truly open. If we look at the market reaction, I think dollar yen's your one to watch for. Really, continues to be the interesting one, and the fact that you've had so little downside reaction to a Fed statement that's, you could probably spin it slightly hawkish, but doing exactly what the market expected, shows that you're probably due something of a pause in what has been quite an impressive downtrend in dollar yen. I think you've seen clients buying dollar yen assiduously over the past few months, and I think they could go, I don't know, about 60% long dollar yen. I think we saw them go up to about 70% long in April and May before it's finally started to turn around. So I think there's still quite a bit more room there for clients to commit themselves more heavily in the direction of buying dollar yen.
Buying dollar yen. Is that that's positive for Japanese equities, isn't it? When you get a weaker yen.
That would be the dynamic we're looking at. So the read across there, of course, if you're trading something like the Nikkei, then you might expect that to continue to improve, and that will, of course, make Japanese exporters very happy and should be a boon for the Japanese economy by and large. But it's an interesting dynamic, the way that we've also seen euro dollar trying to push on above 113 over the last more than a month or so, and you can see on that chart there, if we can stick with actually the 5-minute one works quite nicely, you can see how we're just today we've been trying to push above and not succeeding. And so if that starts to weaken, that will mean actually you get maybe a bit of a bounce in European equities. They've notably underperformed over the last few weeks. Really, you've had continued record highs in the likes of the Dow and the S&P and the Nasdaq, whereas things like the eStoxx 50 really lagging behind quite impressively. So maybe that's due for something of a turnaround now, and certainly that's what clients have been doing over the last few days.
Yeah, James, let's get back to you and take a look in some more detail about the context of where we go from here. The dot plot hasn't changed the outlook for that, and you said that some of the commentary has been positive and negative on the dot plots. But we've also got to consider the fact that when you start to increase interest rates, it does have a dampening effect on the economy. We've already seen today evidence that inflation is turning down. We've already seen evidence today that retail sales is turning down. There was a softer number than expected on the last lot of non-farm payrolls figures. And this interest rate rise today is going to have more of an impact on the US economy. There are some out there that are saying the economy cannot continue to easily bear with this rise in interest rates is penciled in.
That's absolutely right. I mean, the natural rate is now, the current interest for Fed rate is at the natural rate now. So that would be... What is a natural rate? What do you... the natural rate is, if it's above the natural rate, the Fed rate, then it's squeezing the economy. Right. If it's below it, it's stimulating the economy. So at the moment, it's just kind of the Goldilocks scenario, so to speak. But if you do, it's a very, very fine balancing act for the Fed right now. If they decide to hike more aggressively, they could really kill off growth. They could really strengthen the dollar. And if you look at where all the growth is coming from in the United States at the moment, it's from the exporters. So if there's too much strength in the dollar, this could cause a big problem for growth in the United States. And I think that ultimately means the Fed will maintain what we think is this kind of dovish tightening. In other words, interest rates will remain below inflation. Real interest rates will remain negative in that respect. And that's actually, funnily enough, quite positive for gold.
Positive for equities as well?
Yeah, I do. It's about being dovish. Equities it's the drug of QE, essentially. And the moment you aggressively hike rates or take away that stimulus, it could be quite negative for equities. We are a little bit nervous about equities at the moment. If you look at something like the VIX, it's trading exceptionally low. It's only 1% of the time is it ever trading.
Now the VIX is the volatility index. Yes. It's the fear index, I think, that some people call it, isn't it? Yeah. And it's because it's record low, people are not fearful. I guess that's the meaning.
That's the theory, but I don't think it's true. Ultimately, the VIX, perversely, is in what they call contango. So when you roll from one contract to the next, it's more expensive to buy. So if you're short the VIX, it's a great carry trade. You get a great yield on it. The problem is, as soon as interest rates start rising more aggressively, that trade will unwind. At the moment, there's a record number of speculative short positions on the VIX, looking at CFTC data. That's a real risk. So if we see a more hawkish Fed going forwards, that big trade could really unwind. And we're starting to wonder if, is this the next big problem for the market. So they've got to deal with this massive amount of short speculation on the VIX.
I think actually, just going back to one of your papers a month or two ago, you were talking about the fact the VIX should be at something like 20, which is double where we are, well, almost double where we are at the moment. That would indicate a very different sort of environment.
So we created a model on the VIX and used to track it perfectly until a few years ago it started to deviate. We looked at policy statements, policy uncertainty, and a financial stability index, and it did deviate. They have closed a little bit, but it still suggests actually the VIX should be closer to 15, 16 right now, whereas it's at 10.6 at the moment. So that does suggest there's VIX investors are being quite complacent at the moment.
Yeah, okay. James, another question just come in talking about interest rates. I think you've touched on this. When is the next interest rate coming from the US and how should we position ourselves for that? I mean, we've talked about this. There's probably two, I think, more meetings this year where they could move, isn't there?
Given this quite mixed signals from the Fed, but maybe slightly hawkish than expected in the dot plots, although the overall median hasn't changed, it does suggest we'll see another rate hike in September. And then in December, that's when we start to hear this policy normalisation that we discussed earlier. I think it is dependent on how much more weakness do we see in the macro data. The last 2 or 3 weeks have been quite disappointing. If you look at delivered results versus expectations, they are continuing to miss. If that continues throughout the summer, then I think the September rate hike is off the table.
Yeah, okay. Hope that answers your question. Do keep the questions coming. I just want to go back very briefly to take a look at a couple of these US equity markets, because we've seen a rise and a fall today for the S&P 500. This is the index here. This is the daily chart. I just want to take a look at what's happening over an hourly chart to get a better perspective of what's been moving. And of course, we've had that decision in this last hour. So that's the candle that we've got there. And in fact, we are pretty much where we left out the previous hour. So no move at all for the S&P 500. Wall Street, which is the Dow Jones Industrial Average, and that's the 2-minute chart. Go back to the hourly chart to take a look at where we are now. Again, not too far away from where we were when we went into the announcement. Now, let's take a look in some more detail about where we are now on the Dow Jones Industrial Average after the US rate decision. But what about the longer term picture? Here's Sarah.
Thanks very much, Jerry. So the Dow hit a record high at the open of trade on Wednesday ahead of that FOMC announcement. But what about the future? Well, joining us now is Jeremy Wagner from DailyFX, a technical analyst, and he's been looking in detail at the chart. Thanks very much for coming in. I mean, we've seen an 8% upside on the year so far. We're record highs. How much further has it got to go?
I do think that the Dow Jones is going to be running out of real estate in the near term. One of the patterns that I'm following right now is that we may be getting a fake out to the upside before a sell-off that may begin here in the next few days.
And what's telling you that we're going to see this fake out, and how is that really shown?
Well, so on this chart here, the move off of the lows in middle of April is currently in a 3-wave move. And so from an Elliott Wave perspective, that suggests that it could be a corrective type of move. And as a result, we would be looking for the whole pattern to likely be completely retraced in the near future. That would take it down into the low 20,000s.
Which is shown by the red line you can see at the bottom here, this channel that we're creating. When we're talking about Elliott Waves, for those who don't really understand Elliott Wave, can you, and it's quite a difficult one to explain, but can you simplify how to use it in technical analysis?
So in a very simple terms, 5 waves define the direction of the trend. 3 waves are defined as counter trend. So if we ever see a 5-wave move, we can assert that the trend is to the upside. So even when you look to the left side of the chart, the March high is labeled as a wave 3, and that we are in the midst of a wave 4 type of a correction. And so we'll sell off a little bit, but I think support will eventually emerge, and that we may get a retest of the highs in the future later this year.
When you say later this year, I was going to say, what sort of time scale are we looking at for these movements, the retracement back and then back up to the highs?
So the current retracement to the top side, it could go up as high as about 21,500 and still be within the bounds of the pattern of being a fake out to the upside. So at the current price level, I could look for this to turn lower in the near future. And then sometime later this year, probably within a couple of weeks to a couple of months, we find that bottom and then start to head back up towards the new highs.
And when we're looking at new highs, obviously the red line's really showing the channel here that's been created by the wave so far. I've heard other technical analysts talking about hitting up 22,900 by the end of the year. So going even further. I mean, do you think that's a credible, a realistic target to be looking at?
I would say that's a credible target later in the year, but likely going to see a dip down to the low 20,000s before we see a move up into the 22,000s.
So in terms of tradable opportunities here, we need to see a full retracement back before you feel there are any opportunities to be getting into this market.
That's exactly correct. That the near-term move is going to be towards the downside. Maybe we get a fake out lower that clears out the red channel, takes us down into 20,200, 20,000. And then at that point, the weak holders are shaken out, and then it will open the door for the long positions to come back in.
In terms of stop losses for this, I mean, in the markets, we're seeing it very important to make sure they're in place. Where would you be putting your stop?
So the stop loss, I would be holding it slightly above the 20,500 level. Because once we get above that mark, then the pattern becomes invalidated and something else is brewing.
I also noticed on this chart that you've got RSI. How important for you is it that you're looking at different indicators?
So in this case, RSI is also another indication that this is a tiring trend to the upside and that it might be a fake out to the upside. The high that we saw on RSI in March is higher than the current high we're seeing on RSI today, and price is at a higher level today than it was in March, and so that type of divergence is indicative of a tiring trend.
Okay, we do have to leave it there, but thank you very much, Jeremy Wagner there from DailyFX on how he's using technical analysis and indeed the Elliott Wave to forecast where the Dow Jones is going. Back to you, Jerry.
Sarah, thanks so much indeed. Let's just weave this into another bit of news that's come out over the last couple of days. A record share of fund managers believe global equities are overvalued. That's according to a regular survey by Bank of America, Merrill Lynch. James, how do you feel about this? I mean, listening there to Jeremy Wagner about the potential upside still to come for the Dow sometime in the next, not too far away, and then over the summer, perhaps maybe maturing of the Elliott Wave, and then a potential downturn. How do you feel about this in the context of some of fundamental news? And we're getting this survey through from Bank of America Merrill Lynch.
Yeah, I've seen the survey. One of the most overcrowded trades are tech stocks. That doesn't surprise me. It's had a massive rally year to date. It's up 23% versus the broader market up 12%. So a little bit of a kind of unwind from here is quite possible. But for me, it's all about the fundamentals, and they remain intact. You know, ultimately, the Fed statement was in line with expectations. So I don't see how this is going to dent this trade, and ultimately maybe a little correction, but this, in our view, is a buying opportunity. US equities, yeah, they are expensive, and if you're playing the relative game, certainly European equities are much more attractively valued. There's plenty of ways of looking at valuations in the US. The one we tend to favour, quite controversial in some respects, is the cyclically adjusted PE or the Schiller PE. It's very, very high at the moment. And if you are a long-term investor, then actually a preference towards Europe, where actually PMIs are some of the strongest in the world. So purchasing manager indices, corporate confidence is very high. A lot of macro data in Europe is on the upswing. It's slightly disappointing in the US at the moment. So that does probably favour European equities.
That's an interesting point. And Chris, let's bring you back in on the next question we got from a client. This US monetary policy decision today and the dot plot, the way we're expecting interest rate decisions to go in the future. How does this affect other central banks around the world? We've got the Bank of England tomorrow. We've got the Bank of Japan on Friday, of course.
I think it certainly puts a bit of pressure, particularly on the European central bank. It's interesting how this plays in. If you have a rising US dollar, which it may start to rebound in the shorter term, that will put some pressure on the euro. It leaves the ECB some room for manoeuvre. You've seen central banks try and, I think, stress their independence from each other at the moment, where you've moved away from this era of coordinated action because we're not in that crisis period anymore. I think you've seen a bigger shift to really focusing on the domestic situation, far from the days when the Fed used to make reference to global situations. Now it's very much a domestic element. So everyone's really, I think, still operating in their own little way, really, just to sort of concentrate on their own outlook, if you like. What is interesting about that global markets with the indices at record highs and the question of how if everyone thinks it's a crowded trade. You are seeing, though, continued outflows overall from US equity markets. It's not really fitting with the broader theme, but the overall, the running total from equity market inflows or outflows is you're still seeing certainly domestic US equities having outflows, which isn't it's an odd thing to see the market continue to go up, even as people are withdrawing money. So that supports the thesis that maybe we're still not at this sort of crazy optimism top in the markets yet. People have not got to that irrational exuberance, if we want to borrow that phrase.
And of course the flip side of that is, do we sell gold going into this trade?
Well, that would be the thing. If you expect an improvement in the global economy, then gold is not really the place to be, unless you think inflation will tick up. And the Fed's reference today, their projections suggest they see inflation ticking at 2% for the foreseeable future, and quite further beyond that, I suggest as well. So it's hard to see gold doing too well in this inflationary environment in the longer term.
Yeah. Okay. All right, Chris, thanks indeed for you. James, the last point, the point to go away with. What's your takeaway from all this and how it affects us as those that want to trade the markets?
Yeah, broadly in line with expectations, mildly hawkish. I did think it does suggest slight upside for the dollar and slight up. We do our forecast for year end on gold, or fair value is 12.30, so lower than where it is today. I think it will still probably remain quite well bid in some respects, or quite resilient. There are still a lot of political uncertainties to wade through. Donald Trump is a huge uncertainty in itself, and then we've got German and quite possibly Italian elections. So ultimately it will probably remain, there won't be a huge amount of downside to gold, but yeah, a bit of upside on the dollar from here on in.
Yep. Okay, look, James, it's a pleasure. Thanks indeed for joining us. James Butterfill from ETF Securities, Chris Beauchamp. Also joining us from New York was David Song, and William Croft, our man on the trading floor here, watching what's been happening in the moves in the markets after the Fed delivered as expected. And we've got to thank you, the viewer, for the questions that we've had today. Hope we covered those, as many as we had in. A lot of them were really all about the way in which what we heard from the Fed today plays out in the markets, plays out to other central banks around the world. Don't forget that at midday tomorrow UK time we get that interest rate decision from the Bank of England. No change expected, no change on QE. Has the Bank of England boxed themselves into a corner with that drop in interest rates we saw after the Brexit vote last June? Of course, that was very nearly a full year ago. Don't forget, you can join us as well at 7:30 tomorrow morning. Katie Pilbeam will be with Mike Ingram from BGC Partners, taking a look at the markets and how things look as we set you up for the trading day ahead. Doubtless they'll be talking about the Bank of England amongst other things. And at 10:30 tomorrow we'll be with Charting the Markets, and Chris will be taking us through some of the charts as we look at some of the technical analysis associated with the market moves. So the Fed, as expected today. Thank you indeed for the questions. Do join us next time.